Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager and education coach here with Schwab, and this is Long Verticals and Diagonals. It's a new year. You get a new presenter, and I thought we'd sort of kick this one off with a bang. We're going to be talking about taking a long diagonal spread and then doubling its profit potential. One thing that a trader might do to double the potential profit in a spread trade. I think some of you already know which way I'm heading, and no, I'm not going to be talking about just doing twice as many contracts. So should be a really good discussion. I'm really looking forward to this one. Before we get into it, though, of course, I want to say hello to everybody that's joining me here in the new year out there in YouTube. Great to see Carol and Will, David, Cadre69. Who else is here? We have Will, Sim Architect, Life in the Fast Lane, Sharon. Everybody else, thanks for joining us week after week. We really do appreciate your attendance and your contributions here in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live session. This is a Thursday webcast series, and we kick off promptly at 11 Eastern. We'd love to have you here in the live stream. So I'd hope you'd put that in your personal calendar. But I also want to give you the heads up that Kevin Horner is joining us here in the chats with the live stream audience. Kevin's going to be addressing any questions that I can't get to. We all know what a fabulous presenter Kevin is. We know that he brings a wealth of knowledge and experience to this discussion. Thanks for having my back there, Kevin. And Kevin and I would like to issue an invitation to, if you're not following us on that platform known as X, please do. It's the best place to connect with your favorite presenters. You can find Kevin at Kevin Horner CS. You can find me on X at Cameron May CS. But let's get right into it. First thing that we're going to discuss, of course, is the risk associated with investing and trading. This risk is real, so bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as the sole means of investment research. Investing involves risks, including the loss of principal, and past performance of any security or strategy does not guarantee future results or success. All right. So with that foundation laid, let's set up an set of expectations, an agenda for today's discussion. So three things that I want to cover. I first of all want to have a look at what's going on with market conditions. I'm not going to spend too much time on that, but that should just sort of set the stage for the rest of the discussion. Then we're going to get into this strategy known as a long vertical spread. And we're going to be doing, I hope I didn't say long diagonal now that I'm thinking about my intro. We're going to be doing a long vertical spread. And then we're going to add a different approach to it to double that vertical spread's potential for profit. Now, there's a trade-off. Anytime we make, we tinker with the reward potential of a spread, there's a bit of a teeter-totter effect. There's something else that increases as a risk. So we need to be aware of that, and we'll discuss that. But we'll wrap it up with placing a trade on the Thinkorswim desktop platform. Should be a really good one. Okay, Carol says, you're out of practice. You just remember to smash the thumbs up. Thanks for doing that, Carol. That's definitely appreciated. But let's go right to the Thinkorswim desktop. Have a look at what's going on with we'll just use the S&P 500 as our stand-in for the market writ large, that whole, okay? So here's the S&P. We had a great 2024 for the bulls. Finished strong. Yes, there was a rough day right here. And as a matter of fact, if you don't mind a little bit of uncomfortable visiting of history here, we had a rough day on December 18th, sold off hard. And I actually sent out, I put a post on X, asked my followers' opinion. Do you think this previous support level that was resistance back in October, do we think that support might hold? Now, time will tell where we head from here, but actually that support has held for the 9 days following that. We haven't closed below that level just yet. So we'll see. But let's say that our technical trader out there is planning to place a new option trade. And their design is maybe to do a long vertical spread. Well, they have a decision to make. First of all, first decision might be, well, are we going to go bullish or bearish with that spread? Next decision might be, which time frame are we going to go for? So what do we think, guys? Is this support ultimately going to hold? That could be a big question for some technicians. Or could this turn into, does this look to anybody else like a possible head and shoulders pattern, which if completed, oh, and Super Orange Body says, what software is this? Can I access this chart in Schwab? So this is not available in Schwab, but the software is. So if you log into your Schwab online account, go to the Trade tab on your online account, and then look for Thinkorswim. That's the name of this software. This is known as Thinkorswim Desktop because it's software that you download to your desktop. It doesn't cost anything to download it. And once you've downloaded it, you can just log into it using your Schwab username and password. And then you can just go right to the Charts tab, which is where we find ourselves right now, okay? Yeah, but I think that there might be a good number of technicians out there that see a possible Head and Shoulders as yet unconfirmed. And until it's unconfirmed, the typical approach is to assume that this is just another setup of support. And so let's put ourselves in the shoes of our hypothetical trader here, acknowledging that there's a possible Head and Shoulders here. Let's just say that their conviction as they're planning a new trade is that the market will find its support, find its legs, and maybe start to rise again. So that might incline them toward setting up, let's say, a bullish long vertical spread. So we're going to be building a long Paul vertical spread for today's example trade. And we're going to be doing that using Cisco. So before I move to the chart of Cisco, how did I choose Cisco as today's example? Well, a few possible considerations when a trader is looking for a stock to trade spreads on. Number one might be, how liquid is that stock? Illiquid stocks tend to have illiquid options. There can be issues with pricing. It makes them hard to trade profitably. It's already hard enough. We all can acknowledge that, right? Number two is the price per share. High-priced options offer more choices for strike prices that are available, but those high-priced options can also be more expensive, and they can carry larger obligations. On a per-share basis, they can carry more risk. So price is a consideration. Some prefer those higher-priced stocks, acknowledging that there are larger obligations associated with those trades. Others might prefer a little bit lower price stock, and maybe you're okay with having fewer strike prices to choose from. Today, I've kind of gone for one somewhere in the middle, sort of middle double digits range, Cisco. A final consideration is what's going on with the chart. For some technically oriented traders, they look to see if the chart is behaving in a way that seems to align itself with the intended strategy. So with that, let's go to Cisco. So Van Cott says, do you have any scanners for Cisco to pop up? Let me just show you how I found Cisco. It wasn't a scan. It was just Thinkorswim's list of the S&P 500 companies. I just sort these by market capitalization, the largest companies first, and then just went down through looking at technicals, looking at the charts. Okay. But let's go to Cisco. And let's look through that lens of a technical trader. Now, this is actually fading a little bit as we're speaking. That's okay. That's all right. It's the concept of the trade as much as anything. But what a technical trader might note here is that Cisco's been making these higher highs and higher lows. Maybe that inclines the trader toward a technical bullish approach here. Now, recently, there's been a run up from about the 57-ish level up to about 60, and then a pullback. What might some of you recognize this as possibly being? We had 5 days straight up, and then a pullback of about 2 days. Possible bull flag there, right? So our trader, let's say that our trader thinks that we're flagging, pulling back, and bouncing again. And for technical traders, I don't want to oversimplify things, but a number will look for one of two possible signals for entry when just using price as entries. One might be a bounce off of a support area, pullback, and then we're just starting to bounce higher. You can see that today's price, despite the selling intraday, we're still above the recent low. Now, another thing a trader might look to see as a possible entry is a push through a previous resistance, and that might be up here. This is getting in a little bit earlier than that. But let's just say that our technical trader's outlook is for price to continue to bounce and head higher. Yeah, Paul's saying a bull flag into a possible double top, right, Paul? This is another one of those, just like the S&P, we may be looking at a head and shoulders pattern unconfirmed. Paul's noting there's a possible double top here, but it's also unconfirmed. Where would be the confirmation of that? This isn't so much of a technical analysis presentation, but typically a double top is confirmed if we break below the lowest point of that double top. Until then, the assumption is continued bullishness. Carol says, Cameron, you recently presented a class using the Keltner channels indicator. Would you or Kevin be able to send the link to that, please? Yes, Carol. Or another thing that we could do is just go to our Trader Talks channel on YouTube and do a search. Now, the spelling has to be precise. So it's actually Keltner with an E-R. It's the gentleman's name. Anyway, Keltner, just type that in the search box. There it is. Okay. All right, but back here. So let's just say that our trader has a bullish outlook on the market. So they're not looking for, let's say, long put diagonals or long put verticals. They're considering long call verticals. And then they also have a bullish outlook on their stock. So maybe they see stars aligning somewhat. So let's start to put together an example trade. Let's go to the trade tab. In Ocean Life, you're bringing in some other technical indications of possible weakness. There can be other signs of weakness, right? With technical analysis, we can layer on a number of different technical indicators. Some may be suggesting bullishness, some might be suggesting bearishness. And in that case, the trader just has to make their best judgment, decide whether they're going to go ahead with that stock or maybe switch to something else. But let's just go with the bullish outlook for this trade. I'm going to go to the trade tab here and start to structure a long call vertical spread, right? So a quick question. Actually, I'm going to back off that question. I might go back and address it a little bit later when we have a little bit more information. But with a long call vertical, one can be either quite conservative and propose and structure a trade that could offer not a huge amount of reward compared to other possible trades, but it also may have higher probabilities of success. I'm going to go out here to the 21st of February and structure something very much like that. Now I have the spread set to vertical. Let's change that to single, just so that we can see all the individual strikes here. And with the stock trading at about $59, where might a trader go if they're looking for a high probability of success, but they're okay with maybe a lower reward potential for being successful? Well, with that sort of a trade setup, they might go in the money. Maybe I'm sort of eyeballing the 55, maybe the 57.5 vertical spread. Let's see. At this point, I am going to change the spread from single back to vertical, and let's do some quick math here. If I look at that 55, 57.5, it looks like it's trading between 165 and maybe 190. If we split the difference there, maybe it's looking like this is going to cost us, maybe let's call it $1.80, just to make the math simple. So if we were to buy, let's say the 55, I'm going to spread this back out to the single strikes, because I think everybody likes to see the individual legs. If we were to buy the 21st of February, 55 call, it looks like that's trading for around 470 to 485. Let's say it cost us 480. I'm going to use some round numbers here. And at the same time, we sell the 21st of February 57.5 call. This could construct for us our long call vertical spread. If we sell that 57.5, that looks like that's trading between 297 and 305. Let's say that we're able to get $3 for that. Okay. Looks like our numbers are moving around just a bit. Looks like it might cost us a little bit more to get this. Let's say it's 485. Anyway, so we're spending 485. If we spend that 485, that's giving us the contractual right to buy shares for $55. But if we accept this payment of $3, now we have the contractual obligation to maybe sell those same shares for 57.5. All right. Well, if we buy at 55, sell at 57.5, that would be a $2.50 profit if this were a free trade. It's not a free trade. What is the cost, the net debit also known as the max loss of this trade. If we spent $485 and we receive, let's say, a $3 credit, and let me just double check this, see if those are still fairly reasonable prices. Not too bad, not too bad. I think we might be able to squeeze out 8 cents lower at this point. In any case, $4.80 versus $3 leaves us with a net cost of the trade of about $1.80. So that becomes the maximum loss potential of this trade. What is the max gain? And let's label these as theoretical max gains and losses, because if the trader tinkers with the trade at all, if one of the legs gets assigned, there's things that can change the risk profile of the trade. Randy says, is there a level of implied volatility that you're looking for? We'll have a discussion about that in a future webcast, Randy. Sometimes I just have to pick priorities given the limited time frame of each webcast. Yeah, I think we'll definitely focus on that in a future webcast. Okay, yes, Charles. The loss is equal to the spread width minus the cost of entry on the trade, right? So the theoretical maximum, pardon me, the possible gain. The theoretical max gain on this trade is our spread width. It's a $2.50 spread minus the cost of the trade, leaves us with about 70 cents that can potentially be made on this trade. It doesn't sound like a lot, 70 cents, but we're not actually tying up a lot of money in pursuit of that 70 cents. So our trader here is tying up about $1.80 with the possibility, and actually the probability, that they make 70 cents on this trade, which as a percentage is actually quite a high return. So that is one possible trade. Now, what's the likelihood of success on that trade? Well, our trade really just needs to be above 57.5 as we move toward that 21st of February expiration. Look where it is already. It's at 59. It's already over $1.50 above where it needs to be. If it's still up there at 59 and these contracts, we exercise and the 57.5 short call is assigned, we buy the stock for 55, sell it for 57.5, that's a $2.50 gain minus what it costs to set this trade up. That's our 70-cent gain. So this is a trade with a higher probability of success than failure. So for some, they prefer that sort of a scenario. But now I want to get to what I mentioned at the outset of this discussion. We want to take this spread and double its chances or its profit potential. What might we do to do exactly that? Somebody tell me that. Yes, you might say, oh, we could just do twice as many contracts. It's not what I'm talking about. I'm saying with the same number of contracts, what might the trader do to double the profit potential of the trade? Well, in that case, they may go with, instead of in-the-money contracts, we go with out-of-the-money contracts. And I hope as soon as I mention that, little, not alarm bells, but alert bells go off in the trader's mind. Oh, I need to be aware of what I'm doing. But let's compare this trade to, I'm just going to grab all of this. Let's copy this, paste it down here, and we're going to set up a second scenario. So this first trade scenario, just ignore that stuff up there at the top. That's for a different webcast series. Anyway, so we're going to call this example trade A, which is an in-the-money spread. So example trade B, with that tantalizing higher reward potential, is an out-of-the-money spread. So here's what this means. Let me just take a quick peek here. I'm going to cheat a little bit. I'm going to go up here to our spread with single. I'm going to change that back to vertical, and I just want to have a look at something. I want to spend less than $1 to set this trade up, this second trade. That looks like we might be able to do that at 60 to 62.5. Now, I'll explain why it was less than $1 in just a moment that I'm going for. Or I should say $1 or less. Actually, $1 would have done it as well. But setting that back to single, let's set up maybe this trade instead. Let's buy, instead of the 55 call, let's buy the $60 call. What does that do with the cost of what we're buying? Hey, we went from nearly $5 to only about $1.70. So the cost of this trade is going down. Now, with the option that we sell, instead of selling the 57.5, let's maybe sell the 62.5. So I'm keeping the width of the spread the same. Because some of you proposed another thing that we might have been able to do to increase, it wouldn't double the reward potential of the trade necessarily. Well, actually it could. Anyway, but what we could do to increase the profitability potential of the trade is to widen the spread that we had. Now, I'd have to go back and run the numbers to see exactly what implication that had. But I want to look at this, keeping the same spread width, $2.50, but just moving the strikes. That's when I say doing this one thing can double the reward potential of a trade, moving the strikes can double that potential. So when we sell this 62.5 call, what does it look like that's trading for? Between 79 and 83. Let's say that we're able to collect 80 cents here. So now, if we're spending $1.70 on our long option and collecting 80 cents on our short option, what's the net debit between those two now? It's not $1.80, it's 90 cents. And if the same equation applies to theoretical maximum gain, we take the distance between the two strikes, it's still 250, and instead of subtracting the $1.80 cost from that, now we're down to a 90-cent cost. What's left over as potential reward? $1.60. And in this case, we've actually more than doubled the likelihood or the potential reward. Now, Eugene says, what's the risk for assignment in this kind of trade? Eugene, interestingly, assignment is part of the trade's objective. Yeah, let's talk about that. Going back to trade A, what we did here is we bought the right to buy shares for 55, and we took on the obligation to sell those shares for 57.5. Now, buying shares at 55 and selling at 57.5 is actually a profitable outcome. So this is something the trader wants to happen. So yes, we want to exercise and buy for 55, and yes, the trader wants to be assigned and sell at 57.5. If they do, that's a $2.50 realized return on a 180 investment, or in other words, we've turned a $100.80 investment into a 250 value, and we have our realized maximum gain. So when we say, there's a word that gets associated with assignment, the word risk. Is this a risk? I suppose if the trader doesn't want it to happen, rather I'm going to change that word into a probability of assignment. There's actually a high probability in this case that assignment is going to happen and that the reward is going to be realized. We can actually even check that probability just by looking at our delta for the 57.5 call. With a delta of 65, among other things, delta can also tell us how much our option is likely to change with movements in the stock price, but it can also tell us the likelihood that our contract will be in the money at expiration and be assigned. So there's about a 65-66% chance of that 57.5 call being assigned. Okay? So in other words, yeah, a 65-66% chance of maximum theoretical gain being realized in trade A. So, matter of fact, I'm going to put that down here as the probability of complete success. Complete being defined as maximum theoretical gain. Another way that we can just say that is, what's the probability of theoretical maximum gain? Right now, it's about 65% for this trade. Awesome. Guess what it is not for this trade? With spread trading, lots of traders can be attracted to that higher reward potential, but they have to be aware that there's a trade-off here. When the possibility of reward goes up with spread trading, guess what happens to the probability of reward? It goes down. That's the way it works. MVS says, do we need to account for the dividend tomorrow? There is a dividend. There's also an earnings announcement that we need to to prepare for. Maybe wait to enter after the divvy. So why would MVS be concerned? Let me show this on the chart. So right there is a dividend. It's a 40-cent dividend. When a dividend is paid, what happens to a stock price? Well, it's adjusted down by the amount of the dividend. Now, commonly, that sort of washes out in just the rest of the trading of the day. That's quite a common occurrence. But again, it may be a little bit of a concern for someone who's in a trade that is bullish, which is what we're proposing today. Now, I'll also say, though, that the general pricing of options has already been impacted by this dividend. It's not like this dividend snuck up on the options world. They knew it was coming. So prices are typically adjusted downward on calls in advance of these dividends and up for puts in advance of these dividends. So there's already been a bit of an adjustment. It's making these a little bit less expensive than they might have otherwise been. But still, that dividend, could contribute to some selling tomorrow. Anyway, so let's go back. Thank you for the reason that question. I think that was an important one to address. But let's look at the point of this webcast, which was, did we successfully double the reward? Yeah. Maximum theoretical gain is now $1.60 versus a 90-cent investment. Wow. Whereas with the original trade, it was 70 cents potential reward versus a $1.80 investment or risk. So Paul says, when does that price adjustment happen? Immediately, start of trading tomorrow. Yep. For the stock price. It's known as the ex-dividend date. It means those who are buying the stock tomorrow no longer qualify to receive the dividend, so they pay a lower price for the stock. Again, it's theoretical because, it's real. The price is actually adjusted downward. However, that's only one of who knows how many potential influences on stock pricing tomorrow. So it does tend to get kind of blurred. It's not that you can look at a chart, and if you were to disguise where the dividends were paid, the trader would probably struggle to identify exactly which candles included a dividend in them, because trading comes in and kind of washes that out a lot of times. Okay. Paul says on options, on the announcement of the dividend is when those sorts of adjustments are made, Paul. And again, lots of other influences on the pricing of options. Just be aware that that's included. Anyway, so back to our example trade here. We've had an incomplete discussion of moving the strikes. It's great that we're doubling the reward. Also, for some, they see this as great that we've really cut back on the cost of the trade. We actually cut the cost in half and doubled the reward potential of this trade. So this is sounding like, boy, this is ticking all the boxes. Why wouldn't everybody do this? And that comes down to probability of success. What is the probability of maximum gain on this second trade scenario? Can somebody tell me that? What is the probability of maximum gain? Well, we've used the same Greek here. Look at our short strike. That's a 62.5, 29. There is not a 65% chance of maximum gain on this trade. There is a 29% chance of maximum gain. And as a matter of fact, if we want to use the Greeks, what is the probability of maximum loss? Let's throw that up here. We need to get above 60 just to avoid maximum loss at expiration. There's only a 47% chance of that. So the trade-off here is that we are balancing, the trader is attempting to balance the probability of success and failure against the cost of success and failure. What is the price of, what's the price of failure here? 90 cents. And there's a high probability. Actually, I need to invert my number here. It's not a 47% chance of theoretical maximum loss. That's the chance that we avoid maximum loss. It's actually 53% odds of maximum loss. So yeah, there's a 53% chance that we just lose it all. And what is all? 90 cents. There's a 29% chance that we make the full return, which is $1.60. So I always talk about it as a teeter-totter. With spread trading, it's an incredibly flexible approach where a trader can be aggressive if they want to be. If they're very confident in their trade, they can dial up the reward potential for being successful on that trade, but they're also mathematically dialing down the probability of success. And your delta can be your guide for what those probabilities are. So maybe this can help visualize it. Let's go here to our chart. Let's just clean up our drawing set here. And let's draw some lines. Now, Harry says, will you look at a short put vertical for this trade? I won't in this series, Harry. This series explicitly is called long verticals and diagonals. So we're only going to be talking about long verticals in this series. However, just to give Harry's question a quick treatment, the trader could go from long call verticals straight across the options chain over to the short put verticals. And if they stick with the same strikes, their reward, the trade is going to look almost identical. The reward potential, the risk potential, the probability of success, the probability of failure, probability is actually not affected at all by whether we do calls or puts. So that's a good question. Yeah, but Paul, you're exactly right. Yeah, this class is on long verticals. So that's where we're going to be focusing our attention. But just, it might feel like we're restricted. Oh no, we can only do long verticals. We can do all kinds of trades. We can be bullish, we can be bearish, we can be conservative, we can be aggressive, we can go for high probability, we can go for low probability, high reward, less reward, all of that. Oh, so House Malaparthy says trade A looks more attractive. So they're looking at this scenario and saying, kind of like that. Is either one of these inherently better or worse than the other one? Nope. A trader might lean toward trade A if they're not really sure about whether the stock is actually going to go for a nice run or not. And even if it just stays where it is, trade A is likely to work out. Trade B is what the trader might lean toward if they're quite confident the stock is about to make a nice run and they want to leverage that some more, get some more payout for being right. Paul, you've asked a good question. What about exits? We'll talk about exits too before we wrap things up. So let's map these two trades out. I'm going to switch to my channel tool so I can draw two lines. So our first lines we're going to draw at 55 and 57.5 to illustrate this trade. So let's come down here. Let's come just below today's candle, go to 55. This is going to represent our long call in this hypothetical trade. And let's carry that out to the expiration right about there. I could have done a little bit better job of positioning that, but it's within a few pennies. That's okay. And then our other strike was at 57.5, so let's roll this up to about 57.5, close enough. So right there are the two strikes from trade A. And with this trade, the trader just needs to be above those two strikes to be in their maximum reward territory. Look where we are right now. Is this starting to look like high probability? Can some of you see why House there was saying, this one looks better? Well, to them, that might be the case. But what if our trader is quite confident that we've made this bull flag, we pulled back, and maybe we're set to go up? And as a matter of fact, let me pull this y-axis down. If you click on the right axis and drag it down, you can create more space for yourself. What if our trader just sees this channel right here? Here was resistance. Here was support. Right down there, interestingly, about where our other strike was. And I think it looks like we're about set to break out of that channel. Well, if price moves up the same distance, that could put us right up into our maximum gain territory for this trade. If we can just make it up to there by this expiration, that's where our trade pays out its maximum gain. Is it worth risking 90 cents in pursuit of $1.60 if we really think that's going up? Yep, that's a possibility. Now, is that as high a probability scenario? Of course it's not. We saw it in the numbers, now we've seen it on the chart. This stock has some work to do for this trade to pay off optimally. the stock doesn't actually have to do anything other than stay where it is, or maybe just not drop so much in order for this lower trade to work out. Bryce Bird, you say these long call verticals where you need more soaking in, you're appreciating this. Good. Glad to hear it. But we're actually going to place this trade. We're going to risk that 90 cents. It's a lower probability. You can see that it's more aggressive, and you can see why when a trader is more aggressive, going for a lower probability, they better be in a scenario where there's a bigger reward for being right, because being right is harder this way. But let's go place our trade. And as we do that, actually, before we place the trade, let's make a plan. Who was it that asked about exits? Paul says, what about exits? Yeah, Paul, good question. There's actually a couple of events here that could throw a wrench into the works. This dividend, 40 cents, it might cause a relative wiggle in the stock price. It may not be our trader's primary concern. Before expiration, what else is there? There's this. This is an earnings announcement. Yeah. So our expiration is on the 21st of February. There's an earnings announcement here on the 12th of February. So for some, that could send off huge alarm bells. Well, for others, that might be just fine. This earnings could go really well, or it could go very poorly. If it goes really well, how much can our trade make? $1.60. If it goes really poorly, how much can our trade lose? 90 cents. Those are both theoretical extremes, but that's the math of this trade as we're structuring it. So here's what we're going to do with this trade. Even well before this earnings announcement, is it possible the stock just starts to go up and our trade starts to move toward its maximum theoretical gain? Yeah. So here's what we're going to do. We're going to structure our trade that if we can avoid earnings, we're going to do that. If we can get at least 50% of this theoretical gain before earnings, we'll just get out, not even have to deal with earnings. If we can't get at least 50% of this $1.60 potential gain, we're going to hold on and see if the earnings can contribute to additional gains or maybe reverse a bad loss. Of course, that exposes us to risk as well. But that's going to be the plan. Let me show you how we're going to structure this. Let's go to our trade tab. I'm going to change our spread from single. This isn't the only way to place this trade, but it's one of the ways. Let's change that to vertical. And there's our 60, 62.5 set of strikes. I'm going to click on that ask price to create a buy order. That brings up an order for just one contract. So if we did one, and let's set this for 90 cents, see if we can get a fill at 90 cents. 90 cents would be a $90 risk. Now, I just reset this portfolio to start off a new, fresh year. I'm going to be doing 2 webcasts using this portfolio, so I put $100,000 each. So that's $200,000 in this portfolio. You'll see that 200,000 balance here. And let's say for this series, let's keep our risk at about 2% per trade. Well, 2% of $200,000 is going to be $4,000. How many contracts can we do while risking $4,000? Let's get out our calculator. Let's go $4,000 divided by 90 bucks. It's 44 contracts. Now, I hope you're doing the math on this. That's an obligation to sell 4,400 shares at 62.5, but we also have the right to buy 4,400 shares at 60 bucks. So we're going to do 44 contracts on this trade. There we go. We'll see if we can get in for 90 cents. But I want to attach a second order. Now, by default, this is just going to say single order here, down here under advanced order. Let's change that to first triggers sequential. That means if our first order gets filled, it's going to trigger a second or a sequential order to go into effect. And this one is to get us out if our trade's going in the right direction and we can cash out with a profit, at least equal to 50% of the original $1.60 that we calculated we could make. So If the original max theoretical gain, the maximum profit was $1.60, what's half of that? It's 80 cents. So if we're buying in at 90 cents, what would we have to sell this for to make an 80-cent gain? We'd have to sell at $1.70. So I'm going to right click on this order. Let's create an opposite order to exit with a limit of $1.70. And I'm going to make that order good till canceled. So if we buy into this vertical spread for 90 cents, and if at any point between now and just before that earnings announcement, we can get out for $1.70, we're going to get out, take that profit. But I'm also going to set a condition on this order to cancel this exit order the day before earnings if it hasn't filled yet. Because if it hasn't filled, we're just going to let it go through earnings. So we can do that. Come over here to this gear icon. This is where we can add a condition to our order. Click on the little gear, and I'm going to select cancel on day before earnings. Earnings was on the 12th. So let's push this out to February. I believe it was on the 12th. Wasn't that right? I better just double check. Hold on a second. Yep, it was February 12th. Okay. So back here to our trade tab. Let's click on that little gear. Let's cancel this order. If it hasn't filled, on February 11th, day before, and I'll set this, pretty close to market close. Let's just set it for local time around 1 o'clock. Not 1 o'clock. We have to do this in sort of military time, 13 o'clock. Anyway, yeah, this would cancel it at 1:41.19, just right toward the close of trading the day before that earnings announcement. This is set to local time, and I'm in the mountains of Utah, so that's my local time right before close. And I'm just going to save that. And so here's what we've done. We've set up this long call vertical spread with a higher reward. We've doubled the reward potential, but we saw what that did to the probability of success. The trader has to be okay with the fact that our stock needs to get up and do some work. If it's working in that direction and doing well, and it's looking like our debit looks like we should be able to get it for 90 cents with the mid right close to that. Anyway, if it's working in that direction, we'll get out before earnings if we can. If not, cancel that sell order and wait to see what earnings brings, because we have 90 cents at risk with as much as $1.60 that we could make. That earnings, yeah, it could damage the portfolio, but it carries more potential than risk. All right, let's click confirm and send. Buying these 44 spreads, 90-cent limit, we're going to sell those up through the 11th of February for $1.70 if we can. Maximum profit, $7,000. Maximum loss, $39.60. That's just 44 times $1.60, 44 times 90 cents. Anyway, there are commissions to be paid. You do lots of options contracts, there are lots of commissions. That's going to chip into the maximum gain. But let's send this order off and see if we can get filled. Let that work for a moment. I'm guessing it's going to fill here. Yeah. 90-cent debit is what we're willing to pay. 90.05. All right. So I'm going to let that work. But guys, we've accomplished what we set out to do today. Is there a survey? Somebody says there's a survey. Let me just check. Oh, yeah, there is a survey. All right. Thank you for reposting that survey, Kevin. Yes, but we've taken a look at the markets. We've structured a long call vertical, and we've doubled its reward potential, but at the cost of severely impacting the probability of success on that trade. So that's the trade-off. And we even placed an example trade. That's check, check, check. Time for me to let you go. I hope you've enjoyed this first discussion in your new presenter series of long verticals and diagonals. I'm hoping to see you again next week. But before you go, just remember a few things. Number one, make sure that you are subscribe to our Trader Talks channel on YouTube. You can just go right down and click on the subscribe button right now. It doesn't cost anything, but this is where you can come and find our playlists of previous webcasts. You can join the live streams. You can also do searches for specific webcasts. Also, make sure that you're following Kevin and me on X. You can find Kevin at Kevin Horner CS. You can find me at Cameron May CS. Doesn't cost anything to follow, and it's the best place to connect with your favorite presenters in between the live streams. So if you have that X account, make sure you're following your favorite presenters. And thanks for all the likes, everybody. We've had more than 200 people watching this live stream, which is fabulous. 70 people have already clicked the like button. If you would do this for us, be in the habit of every time you enjoy one of our webcasts, click the like button. It shows the presenter that you appreciate their preparation and their hard work. And it also helps that presenter's webcast find a wider audience in the YouTube algorithm. All right, everybody, time for you to go fill out that survey. Thanks, Kevin, for reposting that survey. I always appreciate your comments. It only takes a second to fill out the survey. It's only 2 multiple choice questions in a comments box and a suggestion box. If you fill it out, I'll read it. I always make that promise. And it sounds like our trade just filled. I heard the beep in my ear. You probably didn't hear it, but it filled. Everybody go enjoy the rest of the webcast for the rest of the day. I will see you again next Thursday. I have new webcasts every day of the week, so I'll also look for you in those other webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.